Good afternoon, guys. Over the lunch hour. I'm certainly not going to say happy for this one. Kind of get into a little bit of your money again, because we need to talk about this. If you've taken a look at what's going on in the market, it's about 11:15 here as I'm recording this Eastern time. As of right now, the Dow is down 460 points at 29,619. Okay, we have broken through the 30,000 threshold here, which was psychological support for the market. So probably not going to get any better here for a little bit. I want to give you this as an idea. All right. On January 1st of this year, the market was at 36,338. That means we have lost 6,700 points on the Dow this year so far, or 18.5%. Okay. At the beginning of the year, I said that there's a possibility we'd see the Dow below 20,000 this year. I know, a lot of people said never happen. Okay. If I would have said 30,000, a lot of people would have said never happen. I'm not wavering from the below 20,000 yet. Okay. Goldman Sachs came out this morning and called for a year-end target on the S&P of 3,600. Mind you, right now we're at 3,750. So Goldman Sachs is saying they expect the market to drop further this year. They also said it could go as low as 3,150. Okay, considering we're at 3,700-ish right now, somewhere thereabouts, that means another 16% drop from here. Okay, if we get another 16% drop in the Dow, and Dow kind of moves pretty close in conjunction with the S&P, that'd be another 4,750 point drop in the Dow. That would put us under 25,000. We're getting close. Okay. We're certainly in the correction territory in the markets right now. Like I said, give you a little bit of education here. A correction in the market means a drop of somewhere between 10 and 20%. We're at 18.5. Okay, so we're there. A bear market is when we have a drop of more than 20%. The rate we're going, we could be there Monday or Tuesday. All right. I mean, market's been down 4 or 5 days this week and 6 of 7 of the last 7 weeks. Okay. Now, bear market is a much longer, deeper decline than a correction. Okay. Like I said, bear market represents a 20% drop in the market. Bear markets average 14 to 16 months minimum. Okay. That's a lot longer than your typical correction. We get bounces. Okay. I've had many of them. We had a correction in the market with COVID in spring of 2020. Okay. Bear markets are often the result of, a much more significant change in investor sentiment. Okay. A correction represents a moderate amount of concern for more short-term events. Okay. A bear market is about deeper, more impactful things that could be long-lasting, like an economic crisis, something that's more than just a handful of maybe disappointing earnings reports or something. All right. So let's look at investor sentiment. Okay. What the mutual funds, the hedge funds, the people that have a 401k or invest spare cash. Let's think about what they're thinking, okay? Bank of America came out this morning and said, global government bond losses are on course for the worst year since 1949, and investor sentiment has plummeted to its lowest levels since the 2008-2009 financial crisis. Remember that one? That was the Great Recession. Okay, that wasn't a fun time to be around. I remember that much. Okay. Now we get into all this talk about the Fed screwing up the economy, and I've said many times Jerome Powell couldn't find his ass from a hole in the ground. Okay, and they're trying to manage us into what's called a soft landing. Now I know that gets talked about all over the place, and not a whole lot of people understand what that is. So what is a soft landing? What's a hard landing? What's a crash? Okay, and that's the hierarchy, if you will. Right? The terms actually are taken from the aviation industry, and they're exactly what they sound like. Think about a plane. Lands softly, lands hardly, or crashes, right? Economically, the same things happen. As defined, and I'm going to read this to you, a hard landing can be contrasted to a soft landing, which is considered to be a more desirable goal for economic policymakers. Of course, you don't want it to be a hard landing. To achieve a soft landing, government officials and central banks will gradually reduce expansionary fiscal and monetary policy in an attempt to curb price inflation without sacrificing jobs or unnecessarily inflicting economic pain on people and corporations carrying debt. This is why a soft landing is not going to happen, all right? They're not doing anything on curbing inflation. Inflation keeps going up, even by an inch month over month, Joe, okay? Without sacrificing jobs. Yeah, we've got, 11 million jobs available. Nobody's working, okay? This is the problem. Unemployment, not the unemployment number you figure, the real unemployment number, the U6 number is pushing 20%, okay? Now, unfortunately, the more dependent our economy has become on fiscal stimulus, easy money, okay, it makes it a lot more difficult to wean us off of expansionary policy. It makes the economy a hell of a lot more vulnerable to a hard landing. So typically what we get is a policy-induced boom in the economy that ran on easy money. It's exactly what we saw with the COVID stimulus checks, okay? Throw money in, throw money in, throw money in, and, oh, gee, we didn't have any problems. We came out and, the stock market went up to 36,000, and then it comes time to pay the piper, okay? So we get this boom in the market, and then we wind up having to come back to reality once the printed money stops, okay? That makes it a hell of a lot more difficult for officials to gradually withdraw the expansionary policy. They can't. I mean, this is why you see the Fed raising rates quickly, 0.75% every 6 weeks. I mean, if you noticed, 30-year mortgage rates have gone up more than 0.25% since the Fed made its policy change a couple of days ago, right? What all this results in is a hard landing. That's where we're headed, all right? Where we slow down or basically stop the expansionary macroeconomic policy, and that precludes a stock market crash, financial crisis, or a collapse of investor confidence. We're already seeing the collapse of investor confidence, okay? What's next? We go through this hard landing, then we're in trouble. The markets, investor sentiment is already pricing in a hard landing for the economy. What if this keeps going? Okay. The next step is a crash. Dow below 20,000? That's a crash. Okay. With everything going on right now, the war in Ukraine, okay, BRICS, the BRICS nations trying to change the world reserve currency, the midterm elections, Taiwan, Iran, ultimately the potential for World War III. Sub 20,000 Dow doesn't seem out of the question. Remember, the market hates uncertainty. Can't stand it. And that causes people to get out. When you're a little nervous, or when big banks or mutual funds or hedge funds get nervous, they don't know what's going to happen, they get out. They go to cash. What do you think we're seeing right now? We're seeing all these individuals and institutions moving to cash. I really hope people have been listening for the last year, 2 years, okay, and protected their money. Not that there's been a whole lot of safe havens, okay? Gold is down 4.44% in the last 12 months. Silver is down 12.27% in the last 12 months. Real estate, now mind you, I want to quote this because everybody goes, oh, housing prices went up. Real estate is judged as a whole, commercial real estate, malls, office buildings, strip malls, whatever it is. When you're investing in real estate, you're investing in all this. So this is by the REIT, the Real Estate Investment Trust Index. So I want to qualify where this is coming from. But real estate is down 16.1% in the last 12 months. Okay. This is why preppers have been saying forever to invest in tangible items, supplies you can actually use, food, weaponry, ammo, power sources, clothing, you name it. It's your money. You earned it. Don't let it be taken away from you. If you haven't made the necessary changes now, and again, I'm not giving anybody financial advice. I'm just saying, talk to your professional, whoever handles it. If you do it on your own, have a kitchen table sit down with the spouse and say, what do we want to do? Because can you handle another 20% drop in your retirement plan, in your investable income? It used to be the days back during the Trump presidency. We were up 67% during the Trump presidency in the markets for 4 years. We annualized around 16.5% return. You got that 401k statement and you go, cool, let's see how much money I make. Now you go out to the mailbox and you go, oh crap, how much money did I lose? Just know what's being said. But it's funny because the media is still lying to you. I mean, the headlines that are coming out today, and I mean, this one just dumbfounded me. This is on investing.com. Top of the page, U.S. stocks tumble on fear of global economic slowdown. There's no fear of it. We are smack dab in the middle of a global economic slowdown. It's just a matter of if it gets worse. Guys, if we hit a hard landing, the only thing worse than that is a crash. Welcome to 1929 in 2022. Pinball out.